HHIS has one of the highest yields you'll find in a Canadian covered call income ETF. But once you understand how that income is actually generated, you might look at it differently, because this isn't a typical Canadian dividend ETF. And if you're buying it for passive income, there's a good chance you're missing what's really going on under the hood. In this ETF review video, I'm going to break down exactly how HHIS generates its yield, why it looks so attractive on the surface, and the hidden risks most investors don't realize they're taking. With high-yield ETFs like HHIS, what you see isn't always what you get, and that can have a real impact on your long-term returns. It's time for another deep dive, guys. Let's do this. I'm going to start this deep dive with their performance, but stay to the end of the video to see the risk you don't want to miss and whether HHIS is safe or a high-yield trap for passive income investors. Before anything else, we need a high-level overview of HHIS. What is it? It is the Harvest Diversified High Income Shares ETF. This actively managed ETF holds a portfolio of 20 of Harvest single stock enhanced high income shares ETFs. Man, that's a mouthful. Harvest uses covered call option writing and up to 25% leverage on these top trending US stocks. It has a variable monthly distribution, currently at 27 cents, with a yield of 31.7%. I know income folks will love those juicy yields. More on that later. HHIS was launched in January of 2025. It trades in CAD and it's not hedged. It has $1.3 billion in assets under administration, and it is considered high risk. This is one of the most popular high-yield covered call ETFs in Canada. You can find all this information on the main page of HHIS. There you'll have quick access to other essential literature such as the prospectus, ETF facts, the annual report, and financial statements, all of which I'll be referring to during this video. Now let's get into what everyone loves to look at, its performance. Using the most recent data from Harvest as of March 31st, 2026, since inception, HHIS has an annualized return of 10.4%. Remember, this fund is only 14 months old. It has done very well the last year at 27.5%. However, that changed more recently. Year to date, it's down 12.1%. Last 6 months, 13%. Last 3 months, 12.1%. And the last month, 2%. All negative numbers. Not exactly what you may be hoping for. Compared to the S&P 500 and Nasdaq 100, this is some pretty bad performance. For all of those same time periods, it is important to have something to benchmark to when looking at the performance of an actively managed fund like this one. More on that later. However, looking at the calendar year performance for 2025, it was amazing, 28.3%. Looking at the total return historically, you can see how volatile it's been. In April of 2025, it had a max drawdown of 34.2% in its short history. At one point, it was down 26% since inception. That would have been a quick lesson in volatility. And back in October, it was up 38%. Total returns, we are speaking, and that includes its monthly distributions. Because this fund is so new, there is no best and worst 3-month returns on the fact sheet to look at. Now let's talk about what many income investors like to hone in on, the distribution income. HHIS is a covered call income ETF. It's known for its passive income for Canadian investors. I see passive income investors post about it regularly on Blossom Social, like this one here from BD Investing. As I mentioned, HHIS pays monthly distributions and currently yields 31.7%. I'll break down where that income is coming from when discussing the risks and financial statements, so stick with me. Now, on a cumulative market price basis, the total returns look a little different and less harsh. These are end-of-month figures, mind you. It helps smooth out that performance a little bit. You can see the dark blue share price is trending down pretty consistently. The light blue line is the market price plus the cumulative cash distributions. So if you haven't been invested since inception, you will not have received those $3.61 in total distributions to date, and your performance will be drastically different. As you can see, the distributions have increased slightly over the 14 months, up about 8% from 25 cents to 27 cents currently. It's very important to understand the tax repercussions of these distributions outside of a registered account, which are mainly made up of ROC, or ROC, a return of capital. For HHIS, it was nearly 2/3 of a return of capital. Now, a return of capital is exactly what it sounds like. It is a portion of your initial investment being returned to you. And this is common with funds that pay out monthly regular distributions. I suggest talking to your tax professional for the pros and cons of this in your situation. Now, keep in mind, this performance is after the ETF costs and expenses, which are extremely high for this fund. It currently has an MER of 1.88% and a TER, or trading expense ratio, of 0.27% for a total cost of 2.15%. That high TER is because the fund trades a lot. It has a portfolio turnover rate of 37%. Remember this for when we discuss the risks and how the fund generates or tries to generate income. Okay, now let's move on to the holdings of HHIS, Harvest Diversified High Income Shares ETF. Because this is an actively managed fund with no index to follow, the holdings can and will change at the discretion of the portfolio manager. Currently, this is what they look like. Likely you know every or nearly every name in the portfolio. You may have even used the products of nearly every company in the portfolio without even knowing it. The 20 holdings are mainly mega cap stocks. The top 10 holdings of HHIS make up 66.8% of the fund, with Broadcom and Nvidia number 1 and 2 at 7.2%. The bottom 5 make up 11.3%. A side note, HHIS owns a very high percentage of its underlying single stock ETFs, some as high as 93%. HHIS is named a diversified ETF, but it may not be exactly as it suggests. We can see this in its sector weighting. Tech makes up basically half of the fund, with 9 of the 20 holdings in that sector. Next is communications at 21% of the fund, and consumer discretionary at 13.7%. Only 6 of the 11 sectors are represented in HHIS. The weighting is similar to the Nasdaq 100, but it still isn't the best comparison. The Nasdaq 100 contains all sectors with exception to financial stocks. Quick thing, guys, before we continue. If you're finding value in this video, please smash that like button. And if you really want to be generous, hit that subscribe button too, so you never miss a new video. My goal here is to help out fellow DIY investors. Now back to the video. With that out of the way, let's look at the fund style of HHIS. Remember, this is an ETF holding 20 single stock ETFs that use leverage and sell covered calls. At its fundamental level, this is a large cap growth ETF, similar to the Nasdaq 100. It may shock you. It contains 5 of the largest companies in the world by market cap, all mega caps valued at $2 trillion or more, and 9 of the top 14 in the world. The smallest stock by market cap is SoFi at $20 billion, still a large cap. Even a newer IPO'd stock in the portfolio like Reddit has a market cap of $26 billion currently. Now, you may be thinking why I'm calling this a large cap growth fund when it is a covered call income ETF. It's only because the fund contains only large cap stocks that are mainly growth stocks. By growth stocks, I'm referring to stocks that have high reinvestment of earnings and rarely pay dividends. They're often more volatile and risky, with higher valuations or PE ratios due to high future growth expectations. Palantir is a great example of this in the portfolio. There are some stocks that are more like a blend of value and growth in the fund, but that's the minority. This is important to know because it will impact the options that are sold on the stocks within HHIS. This brings us to the most important part of this deep dive, in my opinion, the risk profile and how this fund is actually generating its yield. Just a quick disclaimer before I discuss the risk. Don't come at me in the comments, please. I'm only presenting the data. Do with it as you wish. Actually, come at me if you think I got the data wrong. I want this to be data-driven and absolutely correct. First off, HHIS has this fund labeled as high risk. That means its standard deviation is or is expected to be above 20 over 10 years. This rating may change over time, of course. For comparison, though, the Nasdaq 100 is rated as medium to high. So HHIS is considered more risky than holding the tech-heavy Nasdaq 100. This is likely due to having 25% leverage on each underlying holding. That leverage amplifies both the gains and losses. According to the prospectus, the use of leverage can be achieved by cash borrowing up to 33% of the NAV. Also to note, as the annual management report notes, the fund remains focused on investing in higher growth businesses. Further confirmation that this is a growth fund. It continues, with strong competitive positions in their respective industries. This exposes investors to higher than average equity risk. While as an offset, these companies generally offer higher option premiums due to their higher volatility nature. Now, this chart showing the 1 and 3 month returns of the underlying stocks of high income shares ETFs really highlights how volatile these stocks can be. Now let's discuss the real elephant in the room. HHIS covered call option strategy for creating income. If you're unfamiliar with what selling covered call options are, you can check out this video here. According to the prospectus, under investment strategy, HHIS and its underlying holdings can sell options on up to 50% of the fund. And the kind of options being sold are at the money, though the prospectus does mention out of the money may be sold at the fund manager's discretion. HHIS also mentions that they may repurchase an option that they wrote that is in the money by paying market value of the option. It's only when the option remains out of the money that the fund will get to keep the shares and the option premium. Remember that. By selling at the money calls on 50% of the fund, that means half of the fund will not have any capital growth. Yet that 50% of the fund is still exposed to 100% of the potential losses. Has HHIS and its 20 underlying high income share ETFs produced the high income intended to cover that 31% yield? Where is this high yield coming from? Let's look at the financial statements to see the reality of trading options on highly volatile stocks with leverage. There is a net realized gain on selling of investments of $50 million and a net unrealized appreciation of $83 million on the comprehensive income. That means this ETF has been selling and buying a lot of shares. Let's look even deeper. Look at the distributions to unit holders. Where was this yield coming from? It was mainly ROC, and capital gains, with a little investment income in 2025. Its distributions are not from covered call income. Did you see the derivative income of HHIS in the financial statements? Nope. For that, you actually need to dig into the financial statements of each underlying single stock ETF. And what do those look like? The vast majority of option selling resulted in a loss. Shocking. Let's go through the underlying holdings with a financial statement for 2025, starting with those with some gains from selling options. Starting with Amazon, it had a realized loss on sale of investments, but had realized gains on options and a net gain. Circle had a realized loss on sale of investments, but had realized gains on options written for a massive net loss. Costco had a realized loss on sale of investments, but had realized gains on options written, yet another net loss. Netflix had a realized loss on sale of investments, but had realized gains on options written, another net loss. Robinhood had a realized loss on sale of investments, but had realized gains on options written, and yet again, another net loss. Strategy had massive realized losses on sales of investments, but had realized gains on options written and a massive net loss with all of that unrealized depreciation. And lastly, SoFi had a realized loss on sale of investments, but had realized gains on options written, another net loss. Those all had a net loss in income when all things were accounted for, with exception to Amazon. Now, every other holding had a realized loss on options written. That's AMD, that's Apple, Broadcom, that's Coinbase, Eli Lilly, Google, but it did have a massive unrealized appreciation. That's Meta, Microsoft, Nvidia, that's Palantir, Reddit, and Tesla. Now, most of these had a net gain in income when all things were accounted for because of the massive realized and unrealized appreciation. The takeaway from this is that HHIS made most of its gains from having its shares sold or called away, realizing capital gains, and from unrealized capital appreciation. The vast majority of the covered calls lost the fund money. That massive yield is coming not from selling of covered calls, but from a return of capital and from realized capital gains on selling the underlying stocks. So far to date, the fund manager has not successfully used covered calls to generate income. It's become a liability for the ETF, really. That is the risk with writing at-the-money covered calls on highly volatile stocks. Sometimes you have to realize gains and let the shares get called away. Other times, you need to buy back the option for a loss and sell another covered call further out in time. The saving grace for HHIS is that some of the underlying stocks like Palantir, Broadcom, Google, and a few others have done very well recently and have carried the performance of HHIS. This is the truth about its yield that no one likes to talk about. To recap, HHIS is a covered call ETF holding 20 underlying ETFs of single U.S. stocks with a yield of 31.7%. It has a high total cost of 2.15%. It pays monthly distributions of mainly return of capital and is considered high risk with a high concentration in mega cap tech and communication stocks. Before I give my personal take, I wanted to highlight the risks again, as this is labeled as high risk based on volatility. HHIS is concentrated in 20 U.S. growth stocks. It targets popular names with nearly 70% of the fund in 10 companies and 50% in tech. The fund is invested in only 6 of the 11 sectors, not that diversified. Even with just 14 months of history, HHIS had a major drawdown of 34.2% in 2025, and it is much more volatile than one might expect. Covered calls are meant to lower volatility. This fund sells at-the-money calls on up to 50% of the portfolio. That means there is no growth on 50% of the fund. Then there is that 25% leverage. That amplifies the upward and downward price movements. This fund has a negatively skewed risk-return profile because of the covered calls, with limited upside and amplified downside because of the leverage. That means HHIS will not recover as fast compared to just a levered ETF holding similar stocks. The fund also has a high rate of ROC with tax repercussions outside of a registered account. Harvest markets this fund with specific advantages. However, the flip side isn't mentioned, so I've mentioned it. Harvest also mentions it is for income-focused investors seeking monthly distributions. As we saw, that income isn't coming from the option premium from selling covered calls. It's coming from the growth of the underlying growth stocks. Now here's my opinion on who this monthly payer may be good for. I think HHIS is appropriate for pretty much no one. That's the honest truth. Maybe it could be used as a small satellite position just for fun. After considering its construction, it would make more sense to just hold the underlying stocks and forego the high fee and covered calls. And after all things considered, I believe HHIS is not suited for you if you can't handle a very volatile holding. It's not suited for you if you want a low-cost tech ETF. It's not suited for you if you want stable income outside of a return of capital. It's not suited for you if you are in the accumulation phase of investing. It's not for you if you want the best risk-adjusted returns. HHIS isn't for you if you're looking to trade. It isn't for you if you want diversification. It isn't for you if you want to lower the volatility of your portfolio. And it isn't for you if... Okay, I'll stop there. So that's my full breakdown of HHIS, the very popular passive income covered call ETF, and the truth about its high yield. Check out my ETF deep dive playlist for videos like this one. See you there.